Two people, same income, same savings, same city. One buys a rental property, the other puts the money in index funds. They both think the other one is leaving money on the table. They're both half right. And when you map out 20 years of actual numbers, not the napkin math, the real math, the gap between them will genuinely surprise you. The setup: Ryan and Daniel both earn $60,000 a year, they both have $50,000 saved. Same age, same starting line, same city. The only difference is what they do with that $50,000 on the day they decide to stop letting it sit in a savings account. Ryan buys a rental property, $250,000 3-bedroom house, 20% down, that's his entire $50,000. He takes out a 30-year mortgage at 7% monthly payment. His monthly payment, about $1,330 in principal and interest. He finds a tenant right away at $1,800 a month. On paper, that's $470 a month going into his pocket before anything else comes out. Ryan feels like he just unlocked a cheat code. Daniel takes the same $50,000 and puts it into a total stock market index fund. No property, no tenants, no mortgage. He sets up a $300 automatic monthly contribution and goes back to living his life. His coworkers ask him what he's investing in. He says index funds. They nod and change the subject. Nobody is impressed by Daniel, but impressed and wealthy are two very different things. Year 1, the feeling versus the reality. Ryan drives past his property on the way to work. He tells people he's a landlord. He's writing off mortgage interest and depreciation on his taxes. Rent hits his account on the first of every month. He's building equity. Home values in his neighborhood are ticking up. Every part of this feels real, tangible and smart. Daniel logs into his brokerage account every few months, sees his $50,000 has grown to around $55,000, shrugs and closes the app. Nothing to tell anyone, no story, no key in his pocket, just a number quietly getting bigger. Says Ryan is winning in every way that's visible. Daniel is winning in the only way that actually matters later. The first 3 years, where the $470 goes, let's run the actual numbers through year 3. Ryan has collected roughly $64,800 in rent. His mortgage payments total about $47,880, leaves $16,920 in gross cash flow. Sounds good. Here's what comes out of it. Property taxes, around $3,000 a year. Insurance, $1,500 a year. In year 2, the water heater dies, $1,200. A slow roof leak turns into a $2,900 repair. One tenant moves out, and the place sits empty for 6 weeks. That's $2,700 in lost rent, plus $600 to clean and relist. And Ryan manages it all himself to save money, which means late-night phone calls, weekend showings, and coordinating with contractors on his lunch break. After every real cost, Ryan's actual net cash flow over 3 years is somewhere between $2,000 and $4,000. Not $16,920. Not even close. And that number doesn't include a single hour of his time. Daniel, meanwhile, has put in his $50,000 plus $10,800 in monthly contributions. At roughly 10% average annual return, his portfolio is sitting at about $76,000. He worked 0 extra hours, made 0 emergency decisions, fielded 0 tenant complaints. But Ryan has something Daniel doesn't. His $250,000 property has appreciated 3% to 4% annually and is now worth around $275,000. His equity, what the house is worth minus what he owes, has grown to roughly $60,000. That's real wealth, built partly with borrowed money. That's leverage, and it's the one card the stock market simply cannot deal you. The hidden costs nobody puts in the thumbnail. The $470 a month is the number that shows up on YouTube thumbnails. Here's what doesn't: vacancy. On average, rental properties sit empty about 1 month per year. That's not a catastrophe, but it's a full mortgage payment with 0 income coming in. Maintenance. Budget 1% to 2% of the property's value annually. On a $250,000 house, that's $2,500 to $5,000 every year. Some years it's a $150 drain fix. Other years it's a $7,500 HVAC replacement in the middle of August that cannot wait. Capital expenditures. Roofs last 20 to 25 years. Furnaces, 15 to 20. Water heaters, 10 to 12. These are guaranteed future expenses in chunks of $5,000 to $15,000. If you're not setting money aside every month for them, you're not running a business, you're running on luck. Property management. If Ryan hires a manager, that's 8% to 10% of monthly rent gone before he sees a dollar. If he self-manages, he's working a part-time job he doesn't get paid for. Problem tenants. A tenant who knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That single event can wipe out an entire year of profit or more. None of this is in the $470 number. All of it shows up eventually. Year 7. The curve starts to bend. By year 5, Ryan is on his 3rd tenant. He's replaced the roof, $8,500, dealt with a plumbing emergency, $1,400. Had the place sit empty for 5 weeks between tenants. He's raised rent to $1,950, which helps, but his taxes and insurance have crept up too. His actual cash-on-cash return, the money he pockets relative to what he put in, is running around 3% to 5% after all real expenses. Not bad, but not the number he was telling people at dinner parties 3 years ago. Daniel is still doing absolutely nothing. By year 7, his portfolio has grown from $50,000 to roughly $140,000, including his $300 monthly contributions. He didn't pick stocks. He didn't time the market. He didn't do anything except leave it alone. The compound growth is accelerating now. The gains on his gains are producing more new wealth each year than his original contributions ever did. Ryan's wealth is growing. But it's growing slowly after expenses, and it demands constant attention. Daniel's wealth is growing in a curve, slow for the first 5 years, then faster and faster with each one that follows. Year 10, the scoreboard. At year 10, Ryan's property is worth roughly $340,000. His remaining mortgage balance is about $165,000. That puts his equity at approximately $175,000. After accounting for every real cost over the decade, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, his total out-of-pocket beyond the original down payment is somewhere between $20,000 and $35,000. Daniel's portfolio, with $300 monthly contributions and 10% average annual returns, is sitting at around $170,000. He put in $50,000 up front and $36,000 in contributions, $86,000 total. The rest is compound growth. At year 10, they're nearly identical in total wealth. But Ryan spent hundreds of hours managing his property. He concentrated his entire investment in one asset in one zip code. He took on $200,000 in debt. Daniel is diversified across thousands of companies and hasn't lost a single night of sleep. Year 20, where they actually end up. By year 20, Ryan's property is worth somewhere between $450,000 and $500,000. His mortgage is paid off or nearly there. His equity sits between $400,000 and $480,000. After 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, his total net cash flow above expenses might be $50,000 to $80,000. Maybe more in a strong market, maybe less in a flat one. Daniel's portfolio at 10% average annual return with $300 monthly contributions has grown to approximately $430,000 to $460,000. Total contributions over 20 years, $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a burst pipe. Net worth at year 20. Roughly the same range for both, somewhere between $400,000 and $500,000. But how they got there is completely different. Ryan worked for his. Daniel waited for his. And here's where it gets interesting. If Daniel had increased his monthly contribution by just $200 from $300 to $500, his 20-year portfolio jumps to around $560,000 to $600,000. Because in the stock market, every extra dollar you contribute gets multiplied through compounding. In real estate, adding more investment usually means buying another property, taking on another mortgage, and doubling your workload. The case for real estate, for real. If I only showed you Daniel's side, I'd be doing what every finance influencer does. Let's be honest about what stocks don't give you. Volatility is brutal. In 2008, the market dropped 37%. In March 2020, it dropped 34% in a single month. If Daniel had $150,000 invested and watched it fall to $95,000 in a few weeks, that's not just a number on a screen, that's physically painful. And data shows most retail investors sell at the bottom and buy back in after the recovery, locking in losses at the worst possible time. No monthly income. Index funds don't send you a check. Dividends on a total market fund run about 1.5% to 2% annually. On $150,000, that's maybe $200 a month. Nobody is retiring on that. No leverage. Daniel used $50,000 to control $50,000 in assets. Ryan used $50,000 to control $250,000 in assets. That 5-to-1 leverage is powerful when values rise, and it's the main reason real estate builds more millionaires than stocks in nearly every survey. No depreciation. Real estate investors can deduct the theoretical decline in their building's value from taxable income, even when the property is actually appreciating. That's a legal tax shelter stocks simply don't offer. Real estate wins clearly in specific situations. When the rent-to-price ratio is strong, monthly rent at or above 0.8% to 1% of purchase price. The cash flow math works from day one. When you treat it as a real business, not a passive side hustle. When you house hack, living in one unit and renting others, your own housing cost drops to near zero while you build equity. And when you use 1031 exchanges to roll profits into new properties without triggering capital gains tax, you can compound real estate wealth in ways the stock market can't replicate without retirement accounts. The real answer: Ryan and Daniel both made a smart choice. Neither of them made the perfect choice. Ryan won the leverage game. He used borrowed money to control a large appreciating asset, generated rental income, and built equity over 20 years. The cost was time, stress, concentration risk, and illiquidity. Daniel won the simplicity game. He let compounding do the work, stayed diversified, kept his weekends free, and ended up in the same place without working a second job he didn't sign up for. The cost was volatility, no monthly income, and no leverage. The real trap isn't rental property. The real trap isn't index funds. The real trap is choosing either one based on a YouTube thumbnail or a podcast clip, without ever sitting down and mapping out what it actually costs you, in dollars, in time, in risk, and in opportunity, over 10 or 20 years. The only math that matters is the math that includes everything. Did you include everything?